Hey beautiful people, welcome back to my channel. Today we're going to do part 3 of my series around the Tax Cuts and Jobs Act. Now, if you watched parts 1 and 2, you know that part 1 was how the tax cut impacts you as an individual. Part 2 was how it impacts you as a business. And today, part 3, we're going to talk about 10 things that you may not know about the new tax bill. Now, if you have watched part 1 and part 2 and have yet to subscribe and you're sitting here watching part 3, I'm coming to get you. Yes, I'm coming to get you. Hit that button, subscribe. I promise you it's going to be worth it. All right, let's get started on my top 10 list. Number 1 is alimony. So for divorce and separation agreements signed after 2018, the alimony payments are no longer deductible on your tax returns. Yep, so we're going to treat alimony payments the same way we treat child support. So if you're a payee, you no longer have to include the alimony payments in your gross income. And if you're a payer, nope, you cannot deduct them on your tax returns. So this will probably change the future size of settlements that are negotiated based on this new tax law. Again, if you have until the end of this year, so if you're in the middle of a settlement agreement, wrap it up before the year ends, because effective January 1, 2019, you can no longer deduct those payments on your tax return. All right. Number 2, the individual mandate. Yep, AKA Obamacare. It has been repealed effective in 2019. So this is another one where you have until the end of this year to get it right. So if you don't have health insurance, you still are going to pay that fee, that tax that the government has imposed on you. But effective January 1, 2019, the mandate has been repealed. There are some projections that suggest that the repeal of this mandate will lead to millions fewer people getting insurance. I guess we'll find out as we progress along and see what happens come 2019 and beyond. Number 3, the moving expense deduction has been repealed. Sorry, yep. If you're one of those people who may move around constantly for work, or you are planning on moving in 2018 for a new job, you can no longer deduct your moving expenses. There is one exception though. If you are a member of the armed forces, you are still able to deduct moving expenses, and they'll continue to apply. This new change, though, for people who are no longer able to deduct moving expenses, it starts with 2018 and carries on through 2025. All right. Number 4, bonuses. If you are an employee who receives a bonus check from your employer, whether it's for, Christmas bonus or just an annual bonus based on performance, starting in 2018, this year, you will see an increase in that bonus, not because your performance was better, or maybe so, but also because the tax rate on that bonus has been reduced. Yep. So bonuses up to $1 million get a tax rate of 22%. Anything in excess of that $1 million is taxed at 37%. The previous rate was 25% on bonus income up to $1 million. So a little bit of a bump there. Number 5, employee stock options. Yep. If you get that benefit from your employer, if you get the benefit from your employer of having stock options, you can defer the recognition of those stock options for up to 5 years. So maybe you don't want to pay the taxes on them right away. You can defer recognition of income on the options for up to 5 years. The election is not available to certain executives, highly compensated officers, and the like. Okay. Number 6 is around retirement savings. So if you're one of those employees who may have had to borrow from your 401k plan with your company, and you left the company before you had an opportunity to pay those retirement funds back, the old rule was that you had 60 days after you left the company to pay back the 401k loan or face a 10% penalty. with this new tax law, you have until you file your tax return. Yep, you have until the time you file your tax return, even if you get an extension, to pay back that 401k loan. So they've relaxed the laws a lot around the money that you are able to borrow from your 401k. And again, if you do not pay the funds back in time, you are going to be slapped with the 10% penalty. All right, number 7, retirees additional standard deduction. So if you watched part 1, you know that the standard deduction for everybody has doubled. But if you're a retiree, 65 or older, you get an additional deduction, an additional standard deduction on top of the doubleization of the standard deduction. That additional standard deduction is this: $1,600, $1,600 for singles, and $1,300 for each spouse in a marriage. So if you're married filing jointly, you get to deduct $2,600 on top of the standard deduction. All right. Number 8, education 529 accounts. All right. So in these accounts, savers contribute after-tax dollars that are invested and can grow tax-free for federal and state taxes. The withdrawals are tax-free if they're used to pay for eligible education expenses like tuition, books, room and board. So normally in 529 accounts, they're used to pay for secondary education, colleges and universities. But the new change allows for individuals who own these 529 plan assets to take up to $10,000 a year per student to be used for private school tuition for kindergarten through 12th grade. So if you're one of the folks who can afford to pay private school, and you're probably already doing it, then you can set up a 529 account, and the income that you earn on that 529 account is tax-free as long as you use it towards first, primary, and secondary education. All right. Number 9, taxes on investment income. Okay, so if you are one of those folks who invest in the stock market, or you have investments outside of your retirement accounts, basically the taxes on those income, that income has not changed. So the capital gains rate for long-term capital gains has not changed. Long-term capital gains are those net profits on investments held longer than a year. The tax rate is still 15%. And the tax rate on short-term capital gains on investments are taxed at the same rates as your ordinary income tax. So no changes on taxes on investment income. And last but not least, number 10, the alternative minimum tax, AMT for short. So the purpose of the alternative minimum tax is to effectively take back some of the tax breaks that are allowed for regular tax purposes. It's a way to ensure that high earners pay their fair share of taxes without overusing the deductions and exemptions that are in place. So the AMT will now, under the new law, impact less filers. Several triggers that were embedded in the prior AMT calculation have been reduced or repealed. In addition, the amount of income that is exempt from AMT has been expanded. And so this is mostly going to impact high earners, those folks who are making lots of money and they were required to pay the alternative minimum tax. You may not fall into that bracket anymore. And that's great for you if you make a lot of money. So those are my top 10. Some of them you may have been aware of. Some of them maybe not. Maybe all of them maybe not. But that's what I have for you today. Stay tuned for my next video. If you are a subscriber, you'll know when it comes out because you'll be on the list to find out these things. Thank you for tuning in. I will see you next time.